My name's Jo Reid. I'm a chartered financial planner and I specialise in retirement planning. Whether you've decided to give up work completely or just move part-time, it can be quite a daunting prospect moving into retirement. You've got assets, retirement assets, and all of these need to be reviewed and understood before you can really begin the journey of retirement. So the Retirement Coach has created a guide for you on how to start taking income in retirement. I think of retirement as an ecosystem. It's quite a complex area and we try and break it down for you. So I'd like to give you 5 tips of things you should consider when you're moving into the retirement phase. Number 1. Gather your thoughts. And that might sound a little bit of a strange thing to do, but rarely do we actually reflect on what we want from our retirement. Often we're busy at work, we're in the 9 to 5, but we don't think, okay, what do I want to do? Do I want to play more golf? Do I want to take up another hobby? Do I want to travel? So really start to think about that. From that, you can then map the costs and, how can you achieve those goals? So stage number 1, tip number 1, gather your thoughts. Tip number 2, is then about understanding what you've got. Over time, we accumulate 3, 4, 5, 6, 7, 8 pensions, and often we don't actually know what that translates to in terms of income. We might have built up some ISAs, some other investments. So the next thing is really get to the bottom of understanding what your options are and what you've actually got. Tip number 3 is then structure them. The earlier you can do this, the better. I tend to say with my clients, you should look to approach your retirement planning about 5 years before you actually want to give up work. And that will give you time to structure everything in a way that's going to be the most efficient for you to achieve that goal. What I mean by that would be investment strategy. You might be taking more risk currently than you should be if you're planning to give up work in 5 years. Again, we've seen volatile markets. So a key point to that is to structure your investment so that you're not actually going to be affected by the ebbs and flows of the markets. So moving on to tip number 4. Tip number 4 is understand your options. There are there are over a dozen retirement options for you. There are 6 different types of annuity. You can draw from the pot, you have cash. You may have other assets that you deem to be your retirement asset pool, but really start to understand what are your options with those different pots that you've built up. Tip number 5, take advice. There's lots of websites now. There's an awful lot of execution-only sites. And that basically means that you're trying to build enough knowledge to make a decision that's going to affect the next 20 years. I've been working in the retirement market for over 10 years now, and believe me, it's complex. So, tip number 5, take advice. So we've gone through the 5 tips. What I'd like to do is actually translate that into a case study that hopefully you can relate to. I met a client about 18 months before he was due to retire. So the first point, tip number 1, was gather your thoughts. So we discussed what he wanted to achieve. And ultimately, he wanted to provide a nest egg for his children. He had 3 children. He wanted to spend more time travelling with his wife and look after his health. So again, improve his fitness. So that was step number 1 for the client. Step number 2 is gather the info. He had a fairly complex situation. He had 4 to 5 different pension schemes, multiple shares and different investments. So we pulled it all together and I was able to give him some ideas on what it all meant. Which income stream should we turn on first? What was going to be the most tax efficient way of doing that? And again, also because he wanted to leave money for his children, considering the whole inheritance tax piece and making sure we could protect those assets. We then looked at structure. So it was a little bit of a mess, so we consolidated. We put it all into something, we simplified it. So he then had peace of mind in knowing that it was simple. He could understand what he had and understand what it would do for him. We then looked at, okay, so we've now put it into a simplified environment. How are we going to structure that when you want to start taking income? And again, this client was going to do a little bit of consultancy work, wasn't going to retire fully, so we didn't need to turn income on immediately. But what we were able to do is take a large percentage, 50% of the pot, as tax-free cash, because it was under a type of regime that we could isolate that money. I then looked to invest that in a way that protected it for his children, so we looked at some trusts around that part of the investment. And then client was really then clear about exactly how much he had, what it was going to pay, when it was going to pay, and we also managed to achieve all of that within a very, very tax efficient environment, so he paid very little income tax. So they were his options, and now I see the client, back to my point of take advice, I see the client every 6 months where we discuss, are we on track? What level of income does he need? He's enjoying the retirement that he wanted. He's travelling. He's been away 3 times over the summer, and we've started to implement the trust planning, so his assets are protected for his children. So hopefully you can understand the type of area and benefits to the client that example gives you.